gas producer as a potential purchase. So what do you think? I mean, what's happening with this deal?
So there's a lot happening in this space. If we have a look at China, it's the second largest customer of potash in the world. And as China's middle income bracket expands and grows very quickly, what happens is that their eating habits change as well, and they want more meat. And if you have a look at how meat, in terms of meat, how much grain is required, 1 kilogram of meat needs around about 7 kilograms of grain. And that's why there's such a huge demand for fertilizer and for potash. But now, of course, we're seeing Saskatchewan coming out to say, well, although the companies may own the mines, that it's the people that own the actual potash. So looking at a potential royalty system in place if there is a foreign takeover of the shares. And of course, China probably won't be able to get its hands on potash by itself. So perhaps teaming up with a Canadian pension fund or a Canadian company would make it more palatable. But AIMCO coming out to say this week that it doesn't see, you know, a bidding war with BHP Billiton, the best deployment of funds that it has at hand. So altogether, it does look like it's an interesting space to be in. But BHP Billiton, at the end of the day, it's the only offer on the table at the moment.
Julia, we will watch and wait. Obviously, a big weekend too. Look forward to speaking to you on Monday.
Thanks, Friday. Thanks, John.
Julia Lee there from Bell Direct. Of course, plenty more to ask our guest host, John Noonan, about as well as we go through the program. More insights and analysis coming up from him on Market Day. Plus, we'll be joined by two other analysts as well to preview the US jobs report out tonight and discuss the likely market reaction. Thanks for joining us on Market Day. Well, after a disastrous month for stocks across the globe, markets have made a comeback in September, with Wall Street rallying for a third straight session overnight. Investor sentiment has improved dramatically on the back of better than expected economic data out of the US and China. But many analysts say the key to more gains on the market is whether the US August jobs report can deliver on expectations.
Predictions for a double-dip recession in the U.S. escalated in August, but data out this week shows those fears may have been overblown. Early Wednesday, China saw a rebound in its manufacturing sector, and the U.S. followed, reporting a surprise pickup in the pace of expansion of its own manufacturing sector.
It came out and basically showed that rather than continuing to slow, there was actually some acceleration.
The upbeat data from the world's two biggest economies helped investors overcome the doom and gloom of the previous month and focus on the positive. Investors largely ignored weaker than expected factory orders and construction spending data, as well as a disappointing ADP employment report. But they applauded the latest news on retail sales, better than expected weekly jobless claims, and a major boost in pending home sales.
This was pretty much a surprise. Everybody is pretty much talking doom and gloom, still taking place so much in the housing market as a whole, and to get a gain month over month of 5.2%, I think that put a little bit of a life into the markets.
But the U.S. non-farm payroll report remains the key driver for markets because of the stubbornly high unemployment rate. Economists are expecting to see a loss of 110,000 jobs in August, an improvement over July's 131,000 job loss.
Everybody is looking for the growth in the jobs. In the private sector, we're looking for a growth of, I believe it's 71,000. So we'll see how it all plays out. My hopes aren't too high. I just don't want to, get a little bit ahead of myself, but I'm optimistic.
And because of the optimism sweeping the market this week, some analysts say Wall Street is likely to rally as long as the data meets or beats forecasts. Heather Gillette, Sky News Business.
And joining us now to discuss the upcoming US jobs report, Ray Attrell, Global Head of Research at Forecast Australia, and Tony Morris, Interest Rate Strategist at ANZ Bank. And of course, our guest host, John Noonan from Thomson Reuters, here with us in the studio. John, if I could start with you, just how key is this August jobs report going to be for markets?
Well, the U.S. non-farm payroll data every month is a major event. It's got a very huge psychological impact on investors as gauging the U.S. economy, and particularly as the job sector in the U.S. has been one of the Achilles heels for the U.S. economy. This lack of job creation has been such a worry. Now, coming into this number, I think that the markets become, or investors have become used to these numbers disappointing a little bit. So I think there really is a risk that if the numbers do come in on close to expectations or better than expectations, and it really you have to focus on the private payroll number, and the expectations there is between 40 and 50,000 rise in jobs. So if it comes in around that level, I think the risk assets will move higher, and I think that it'll be a very positive for the market. If it's a really lousy number, if it's a really terrible number, that could take the air out of this nice little balloon that we've had this week where everything's been rallying on. Maybe the U.S. won't double dip. So it's a very important juncture, always an important number. Now, I would like to ask one of our guest hosts, and I'll start with you, Tony. It's really going to be interesting how the U.S. dollar reacts. So I'll put this scenario up. If the number is better than expectations, if it's considered to be a good job number, is that good for the dollar because it means that QE strong will be pushed to the background? Or is it bad for the dollar because risk assets are going to rally and they'll use the dollar as a funding currency?
Well, thanks, John, for the question. Actually, I'll take the view in terms of positioning first. Remember, we've got a holiday in the US on Monday, so maybe market positioning, you might see some adjustment to positions after the number, as long as it comes in line with expectation. On a good number for the US, I actually think that's good for risk overall. You might see, say, the euro and some of the commodity currencies doing a little bit better. We do know, actually, in terms of positioning going into this, that maybe there's more risk in the Treasury market. There's a lot more expectation there, it seems to me, with US 10-year yields just hovering just above 2.5%, that if it's a strong number there, there's a real risk that you could see some of these longer-term US yields spiking higher. But I think in terms of the currencies, if stock markets like it, you'll see the US dollar weaken a little bit and some of the peripheral currencies do a little bit better.
Thanks, Tony. And Ray, if I can ask you, if Tony's right, and I think he is, if you see U.S. yields, particularly in that 10-year area, move up quite a bit as some of these safe haven strategies unwound, does that mean the dollar strengthens against the yen and we get a nice big move higher in currency, some of the risk currencies like the Aussie yen and the Kiwi yen?
I think that's the risk, but it's not necessarily the knee-jerk risk. I think, as Tony was saying at the start of his comments, and you were saying, I tend to agree that if we get, say, less bad than or numbers that are no worse than expected, then I think the risk is that the equity market will take comfort from that, and equity market strength at the moment is synonymous with dollar weakness. So that's the way that the markets will trade immediately out of there. I think the FX market will just take one look at how the S&P futures are trading, and it will take its cue from that. But ultimately, this dollar weakness over the last 3 or 4 months has clearly had its roots in the decline in US Treasury yields relative to yields in the rest of the world, and in Japan in particular. So anything that's likely to push US yields back up towards, say, 3% at 10 years. And there's obviously a lot of expectation built into the Treasury market that the Fed is more likely than not going to engage in some further quantitative easing in the months ahead. Anything that shatters that illusion, I think, is prone to cause quite a significant snapback in yields. And ultimately, I think that will bring the dollar higher. But as far as today is concerned, and I think the risk is a weaker dollar on weak numbers.
Yeah.
Sorry, a weak dollar on better than expected numbers.
On better than expected numbers with that risk appetite go. And Ray, if I just come back to you on that, you would think that if that's the case, the Aussie dollar could be a very, very popular currency. If risk appetite increases, if you see a rally in the asset markets, how high can you see this Australian dollar going if we do get a risk rally and the U.S. yields in the 10 years move higher?
Yeah, well, we're sort of fighting this rally in the Aussie dollar, partly because, almost irrespective of what the payroll number shows today, we do think that there will be increasing signs of contagion from US economic weakness, which we think is not over by a long shot. We're looking for third quarter US GDP to be close to flat and weaker growth in Europe going forward. If that happens, I think that will come and bite the Australian dollar on the backside sooner rather than later. We're also seeing in the Australian markets that levels above 91 cents, which we saw yesterday morning and this morning, seem to be drawing forth a reasonable amount of domestic importer selling of Australian dollars for foreign currencies. So I think the upside from here is going to be quite laboured, and I'd be surprised if we can get above, say, 92 to 93 cents. And in fact, I still think the bigger move as we move further into third quarter is that the Aussie dollar is going to drop back below 90 and head down towards the mid-80s at least.
Thanks, Ray. And Tony, what's the ANZ House view on the Australian dollar as we get to these very high critical levels?
Firstly, the context here is amazing, isn't it, when we're looking at the risk of a US double dip and slower growth, that the Aussie's trading at 91, but a lot of that's to do with US weakness. We were quite upbeat on the domestic economy, particularly in light of the data that we've seen this week. Gives us a lot more confidence that we are looking at higher interest rates here at some point down the road. The only trouble is, and remember next week as well, we get the RBA and we get some further update on the labour market. That comes in strong. I think the market, in terms of our interest rates, might start to turn a little bit more as well, and you get a higher interest rate differential supporting the Aussie. Trouble is that the market looks very, very long, the Aussie, so I agree that it's going to be kind of difficult in the near term to get the Aussie much above 92. We would expect to see very good support for the Aussie if it did dip much below the 90-cent level. Remember, there's an awful lot of still this ongoing diversification of global central bank reserves, very strong gold story, etc., interest rate differentials. You really need to see some sort of real new weakness in the global outlook that would need to drive the Aussie much lower from there.
John, what are your thoughts on the outlook for the Aussie?
Well, yeah, I felt for some time that this 90 to 93 cent level would be quite toppy because of all the uncertainty. I mean, if we were looking at the possibility of the U.S. economy really sort of taking off and soaring in the last half of the year, and or China doing the same in concert with that happening, then I would be very, very bullish on the Aussie. I agree with the other commentators and what Ray was saying, that there's too much uncertainty out there for the global growth story. Even if we don't get the double dip in the U.S., I can't see the type of amazing growth that we'd see to push the Aussie anywhere near the 95-cent level.
John, great stuff. We've got plenty more to ask you about too. We're just going to say thank you to our other guests, though, Ray Attrell from Forecast and Tony Morris from ANZ. Thank you both so much for joining us today.
Thanks, Brady.
See you, Tony. See you, Ray.
Now, let's just take a very quick break here on Market Day. After that, we'll debate whether putting your money in gold is really a golden move for your investments. Now, staying on guard, the Aussie market closes just above the black line as investors remain cautious ahead of the much-anticipated US jobs report. Plus, beware of iron ore, why one commodity expert says he doesn't like the metal past a 2 to 3 year time frame. And this weekend will be critical for Australia's political future as the 3 independent MPs decide which party they'll support to form government.
This is Market Day.
Thanks for joining us on Market Day. Just a quick reminder of where the Aussie share market ended the session today. And as we mentioned there in the headline, pretty flat, really up about 0.2%, up 8 points at 4,541 points and well off the high of 4,558. For the week, though, a very good gain, up nearly 4% for the week. So certainly a great start to September after that 4% loss we saw over August. New Zealand share market higher today, put on 0.8% to finish at 3,107. And around the region, gains too, but very modest gains. The Nikkei there up 0.6%, 0.25% gain for the Kospi, similar rise for the Hang Seng, and the Shanghai Composite pretty flat there, up just about 2 points or so. And a quick check on some of those key commodities there for you. Gold after a nice lift overnight. Gold at the moment pretty steady there. Silver a touch weaker, and copper after its good run off by about 0.4% or so at the moment.